Hi, good afternoon, everyone, and welcome to today's COL Conversations. I am your host, Chino Tobias. We have a very special episode for everyone today, as we've invited none other than our own, COL's very own asset management company called COL Investment Management Inc., or CMI. They are here today to talk to us about how we can take advantage of today's difficult stock market. Now, I'm very excited to get things started. But before that, of course, we do have some reminders. I would like to remind the audience that this conversation is not an endorsement nor a recommendation to invest. Instead, this conversation is conducted for all of us to have a better understanding of the company, the people behind it, and of course, to help the audience make more informed investment decisions. Okay, so without further ado, I am very happy to introduce to you to our guests today. They're here to help us learn more about COL Investment Management Inc. Joining us is CMI's President and Chief Investment Officer, Mr. Marvin Fausto, and Fund Manager for both their COL Equity Index Fund and COL Strategic Growth Fund, Mr. Zerge Zandueta. Good afternoon,
Hi.
gentlemen.
Hi, Chino. Afternoon.
Hi
How are
to
you
everyone.
guys?
Good. Thank
Okay,
you.
I'm very excited today. It's nice to see. It's a different type of episode. We're speaking with people from within the COL family. No? So let's get the ball rolling. Marvin, Zerge, thank you again for being with us today. Before we get to the actual conversation segment of the program, Marvin will be giving us a sneak peek on what they are anticipating for next year. 2023 has essentially been such a difficult year. Very similar just to 2020, 2021, and 2022. What are you guys seeing early on? How is 2024 looking?
Yeah, hi. So allow me to share my screen. Let me share with you how to actively invest for growth even when the market says no. So this is the title of our conversation today. But allow me to share the slides and let's go straight to the point, no? And let me look at what we see or what are the trends we're looking at for 2024. So I divided it into like 5 major themes that we are actually looking for 2024. These are the themes that most probably will dictate how the markets will perform or how the markets will behave for the coming year. And then, given these themes, what particular appropriate strategy can we implement for our portfolio? Okay, so these are 5 themes that we have. Higher for longer, basically inflation, interest rates, inverse correlation of bonds and stocks. Bonds are doing better now versus stocks. There's an inverse correlation. And then the lag effects of this high inflation and interest rates. And then we'll talk about how irrelevant now the Philippine stock market is among foreign investors. That's why there's a case for stock picking. And then, despite all of these issues, we still believe that there's resilient growth coming in for 2024, particularly for the Philippines. Okay, let's dive into the slides that I prepared for you today. First theme, higher for longer. We're really talking about inflation and interest rates. You see here the chart is the US inflation, which really affects the world. As you can see, the inflation has peaked sometime in July 2022, now has gone down, but it appears that it's kind of stabilizing somewhere where it is right now. And for the Philippines as well, it's more or less kind of the same behavior. It has gone up and have corrected since January from a high of about close to 9%. Now we're nearing about 6%, 5 to 6%, somewhere there. And now it's kind of hopefully stabilizing at this level. But what we can see coming in for 2024 is that this level of inflation is something that we will be expecting to be sticky for a lot of reasons. But basically, it's going to be affecting our things that happening in the country, more particularly interest rates. In the US, for example, this is a chart on US interest rates, the 10-year US bond. As you can see, quite recently, it has gone up to a high of about 5%. Now it's about 4.5%. So it's really a reaction of how, because of interest rates, the Fed has been jacking up of increasing their policy rates. So you see the 10-year bond increasing as well. In the Philippines, it's the same. We saw interest rate high about 8% sometime in 2008, has gone down to 2020-21, and now has gone up again. And currently, the 10-year bond is around 6.5%. And the basic reason is really, one of the biggest reason is really geopolitics. And the biggest conflict that we are seeing right now is really the US and China. The US and China trade conflict and the things that they're doing. Although recently, Biden has been talking to Xi Jinping, that the leaders have been talking, but it appears that conflict is still elevated. This chart is telling us the importation of the US from China. The dark blue line is the importation of the percentage of imports that the US that's coming from China. And you can see that from a high of about 21% back in 2017, it has gone down to about close to 13%. It peaked around 2017. I think that was the time when Trump was still the president. And we've been hearing a lot of things about the conflict has escalated towards those two countries. So much so that their importation has gone down. US importation from the US has gone down. And even Mexico now is the one, is even higher. They import more in Mexico. It is not now, governments and even corporations are not necessarily getting supplies or production from the cheaper producers anymore. It's now more from a more stable or more reliable supply. They call it nearshoring or onshoring. And this has elevated the inflation, I think, for the coming years. And I think this is something that we are seeing exacerbated by the pandemic due to the disruption in supply chain and some geopolitics issues like what we saw in Ukraine and Russian war and of course the war in the Middle East, which kind of affected and might affect oil prices. The second major theme that we're looking at for 2024 is really the inverse correlation of bonds and stocks. What we have here is the chart of the 10-year bond, the Philippine 10-year bond, the light black line, more or less now somewhere around 6.5 to 7%. And the stock exchange, the Philippine Stock Exchange, the PSEI, around near the 6,000 level. Now, there is an inverse correlation simply because of the Philippine bond is really very attractive at this point. I mean, at around 7%, that's about a net of about 5.3%. If you get a net of 5.3% guaranteed, I mean, it's a no-brainer for you. Just put your money there and just get a good yield guaranteed by the government. Now, for you to consider a riskier asset like the stock market, investors will have to expect a bit of a higher expected return. Or in math, it's like 1 over the PE, which is about the 12 times PE, giving you a expected yield of about 8.3. 8.3 is somewhere about 50% premium over the 5.3% net yield that you're getting from the 10-year bond. And that is the reason why the PE of the market is around 12 times. Now, if interest rates now suddenly goes down to about 1 to 2%, that could probably be the time when the PE ratio can be justified to increase at a higher PE ratio. And if you compare it historically, analysts have been saying that the market is cheap relative to history. While it is true that the 12 times PE forward PE for the market is cheaper than the past probably 10 years, it may not be as cheap if you compare it to the bond market. So relative to the bonds, stocks is basically the market is basically fair because it's giving you just enough premium for you to get into a riskier assets. So stocks have been derated, and until we see interest rates go down, most probably that's the time we can see stock market to improve. Now, the third theme is the lag effect of this inflation interest rates on the general economy. We see that in the Philippine GDP, and consensus forecast is looking a little lower than what it has been for the past several years. Simply because things are more expensive now, people will have to pay more in interest, and it will take about a few more months or next 12 to 18 months to see the effect, the full effect of this that we will see in 2024. That is also true, not just the country, but in the US more particularly in terms of US consumer resiliency. We ask if it can last because this chart shows us the red line is the new mortgage average rate in the US. As you can see, there's a sudden jump from 2021 from about the level of 3% to about more than 5%. These are new releases, so new mortgages. But if you look at the average, the black line, you can see that it's still very low. It's still low compared to where it is right now. And it will take time, next 12 to 18 months, before mortgages are repriced. And then we will see the lag effect. And that will hit the consumer spending in next year. That's why there's a lot of question whether is the US going to go into a recession or is it going to just slow down? And the biggest cause of that is the high inflation and high interest rates. Another lag effect, we can see also that in the Philippines. This is a chart of one of the largest banks in the country. And I would like to point out the average yield on loans that they currently have relative to the policy rate of the central bank. As you can see, the average loan yield on receivables is about 7.2%. At 7.2%, compared that to 2019 or pre-pandemic, 6.7%. That is only an increase of about 0.52. Now, compared to the policy rate, pre-pandemic at 2019, the BSP rate was 4%. It has gone to 6.25. And quite recently, a couple of weeks ago, they had the off-cycle increase of another 25 basis points. So the policy rate was up by 225, 250 basis points relative to the yield on the loans of this large bank. So it may take a while as well. The lag effect will be felt more particularly next year. Having said that, however, a positive or kind of opportunistic lag effect is a report by the largest fund manager, BlackRock. And based on the experience since February 1995, stocks generally do well after the Fed is done, meaning after the Fed is done hiking rates. The question is, are they done hiking rates? Well, reports show that it appears that they are done with hiking rates so far, like they made a pause. And if we are going to expect cutting of rates, which consensus are looking at next, somewhere around the second half of next year, when they probably cut rates. But what the experience tells us that it is during the time when they stop, when they are done increasing rates, that's the time when we see growth in emerging market equity, dividend stocks, US equity as the best performing asset class. Fourth theme that we have is really the irrelevance of the Philippine stock market as far as the foreign investors are concerned. Now, why do we point this out? As you can see, this is the basket of emerging market weightings. You have China, the 30%, India at about 16, Taiwan 15. And the Philippines is actually cannot be seen. So I'm adding it there at a very low, very small 0.61%. So among emerging market basket, Philippines only account for 0.61%, hardly anything. So more and more, this has gone down to from about 1.5% about years ago, and then now it's about 0.61 and continues to go down relative to the other markets. As well, the foreign investment ownership as well in the Philippine Stock Exchange companies in the index has dropped from a peak of 31.4% in the third quarter 2013 down to only about 23.4% as of the third quarter 2023. Effectively saying that what they have bought from the previous years have already been sold. Much of it have already been sold. Now, why is this important? Is that the case for stock picking may now be more relevant, meaning we will not be dictated as much by the flows of these foreign passive investors through index investing or passive investing, but returns or yields can now come more from stock picking. There won't be as much noise from the flows from foreign, but more for Filipino investors investing in the stock market. Another point of relevance is that the volume really has gone down. This is the average daily stock market turnover in October 2023. And as you can see in the Philippines, this is in dollars, about $50 million, as compared to Thailand's close to $1.2 billion per day. Vietnam's 500, Indonesia's 500, in Singapore is like close to 500 as well. So more and more, there are less and less foreign investors in the country today as well. Having said that, however, the fifth brings us to the fifth and probably a more positive view on themes for next year as well, is the resilient growth of the country. This chart is what some of you have seen this in the most powerful chart saying that we continue to remain to be the youngest population compared to other countries, an average of 25 years old. So as compared to, let's say, Singapore's more than 40 years old, Thailand's 40 years old, China is nearing 40, United States, we're even younger than Vietnam, Malaysia, Indonesia, and India. Now we continue to make babies, and the average 25, these guys are not going to stay home. They're not going to retire. They're going to go out. They're going to start a business, look for a job, start a family, buy a house, buy a car. They're going to spend. They're going to earn. They're going to invest. And that's the basic reason why the consensus forecast for corporation is that it's going to continue to grow. This is the forecast of companies, the stock exchange. It will remain positive. While slower for 2023 is about 12.6% growth in EPS. 2024, about 11.9, close to 12% as well. In 2025, around 8%. So despite the slowdown around the world, corporates are going to grow earnings consistently expected for the coming years. So there is going to be much growth, still resilient. And this will have to be funded. It has to be powered and supported by energy. We will be needing much energy, with the Department of Energy expecting a 6.97% annual compounded growth rate required to support the growth of this economy. So the reason why I'm saying that is that there is potential for energy companies. So that gives us a brief preview of the five themes that we're looking at, and we can look at strategies so that given these five themes that we have so far right now. Chino?
Yes. Thanks, Marvin. Very interesting. I'm happy to be part of the 25-year-old average. Just kidding. But very interesting. It's something that we really see. No, it's such a young country. But what something notable also that you brought up that 0.6% no of the in the EEM weighting, that's really pretty insignificant. No, but yeah, in a nutshell, no, as you said, with those five themes, equities basically is going to continue to have a tough time given this higher for longer interest rate environment. But of course, the long term still looks positive. Very promising pa rin tayo with the demographics of the Philippines, as I mentioned, and of course the fundamentals. No? So yeah, with those five themes, no, Marvin, how should we as investors work that into a strategy? What type of strategy kaya should we put into play?
Okay, sige. Let me move now to the strategy that we're looking at given those five themes. Basically, let me just summarize it so that we can take advantage of these trends. Okay. This is how we see the investing cycle playing out for 2024. Given the high rates, it's a no-brainer you put short-term fixed income investments in your portfolio for the meantime. You're getting 5-6% on your time deposits, your money market, and short-term investment, fixed income, guaranteed by the government. I mean, it's while you wait for things to happen as a start of the cycle. Now, then move on as interest rates peak. Looking at longer dated fixed income or bonds, and then move it on to equities. It doesn't go sequentially like this, but this is in terms of priority given what we have right now. We can do certain reallocation of asset classes, but this is how it's going to play out. And what are the triggers to watch out for in terms of this sequence of strategies? First, moving your cash to fixed income, there has to be a clear sign of a recession or a slowdown in economy, more particularly in the US, which will give us signs where are they really going to cut rates. So only the sign, just the sign or the message that they might already be cutting rates is already the trigger for us to move on to fixed income investments from your cash and make your investment earn. Now, moving from fixed income to equities, the triggers are central bank rate cuts. Of course, because when you cut rates, it's going to be more profitable for corporates because of lower interest rates, maybe stronger demand, and stability in earnings growth for the companies. And also, technically speaking, looking at the bottoming out patterns, and we see some accumulation there. So, in a nutshell, that's how we see it playing out. We can talk about security selection later on, as I probably pass this on to our portfolio manager, Zerge, Chino.
Yes, thank you, Marvin. Yeah, exactly that. No, with the triggers to watch and that strategy. I guess the next question really is for our fund managers, Zerge. No, how can the investors apply that strategy and put it into action, naman? You know, bring it to the next level. Could you walk us through that?
Yeah. All right. Yeah, good afternoon, everyone. Thank you for making time for our presentation this afternoon. I hope you could see my screen. Nag-reopen na ata, mahirap na mag-control na ulit ng Zoom. So sana everything is clear from here. So in any case, I'll actually begin here with the conclusion. So given everything that Sir Marvin has informed you guys, this is the summary already of how we could capitalize. So I present you here the game plan in terms of how we could take advantage of the themes that was presented. So first, on the higher for longer, our advice for our investors, how do you translate that to your portfolios? Is you could prioritize buying financials, especially those with large and sticky deposit bases. So definitely with higher interest rates, banks in theory should be able to reprice their loans higher. Pero the type of banks that you want are those that also have a big CASA. Kasi kung hindi, lalaki din yung kailangan nilang ibayad, right, to their depositors. So those are the three big banks. You also want companies with pricing power. So as Sir Marvin mentioned, inflation is a concern in today's environment. And of course, the problem with inflation, if you're a business, diba, your cost, your commodities, your raw materials, they go up in price. So if you don't have pricing power, hindi mo pa price on yung cost mo sa customers mo, you're gonna take a hit on your margins. So I also put utilities here because the way, like let's say in the Philippines, a lot of our utilities are structured in terms of their pricing. May mga inflation adjustments that are passed through in terms of their pricing. It's considered so that, like say next year, if inflation is high this year, you could actually quite bet yung babayad nyo sa Meralco yung akit yung presyo. And in line also with this team in terms of what to avoid, you want to stay away from companies with very high debt, especially those that are in US dollar denominated debt and those that have a lot of variable or floating rate debt. Kasi mataas yung interest rates. On the next one, in terms of the lag effects. So basically, you view lag effects, yung tinatry lang natin sabihin dito is that the recovery in the market may take time because everything that the Fed, the BSP has done over the past few years in terms of increasing rates, it will bite at some point in terms of the economy. So the way you actually address that is you need to be tactical in today's environment. So in terms of, like, let's say your portfolio, you should have cash on hand. Yun yung sinasabi natin dito na keep dry powder. Because the market could move up and down, could be volatile. Because the sentiment towards stocks at this point is still a bit weak. And you really need to adopt an active investing approach. So like let's say just the simple buy and hold strategies, which may have worked in decades past, given the tough equity environment today, it might not be the most appropriate. In terms of Philippine irrelevance, you want to focus on high dividend stocks. You want to be paid to wait while the equity market is still not performing. And you might want to take opportunities during index rebalancing. So as I said, you need to be tactical, more tactical in today's environment. I'll actually offer a little bit of advice to our audience. Hindi rin siya advice, hindi rin siya tip, but keep at the back of your mind. Like I say, when I talk about this index rebalancing, one of the biggest services out there is FTSE. And if you look at it, SM is not yet, it was taken out of their major index, and it hasn't been returned yet. Diba? So you, like I say, if you're trying to play along this team, that might be a trade at the back of your mind at some point. And it's SM. That's the biggest stock in the country, right? In terms of the long-term resilient growth, you also want to be allocated in power. You want it to be allocated in infra. Those are sectors that we like. So I hope you bear with me very quickly, at least in terms of this next segment. So it might be a little bit, I'm not sure if, I hope not to bore you with this portion, but in keeping also with our title, we were telling you, how do you actively invest when the market says no? I just want to share with you here actually our investing process. And the reason why I want to do this is twofold. So first, I hope this is something that helps you in your own journey in terms of selecting stocks that could perform in today's environment. And at the same time, if you don't feel like the inclination in terms of doing it yourself, you might want to just entrust, like I say, your funds to somebody else to manage it for you. Hopefully, by describing our process to you guys, you could gain confidence in our group to hopefully be able to manage your money for you. So before I begin with this, I want to give credit to Fame Asset Management in Malaysia. So they served as the inspiration for this model. So the way we approach, like let's say, our stock selection, our portfolio construction, is we begin with a bottom-up approach. So the point of this exercise really is to be able to narrow your universe of stocks, diba? To say, ano ba yung mga gusto natin bilhin? Ano ba yung mga stocks dyan na on their own personal merit, maganda talaga? And those are stocks that are worth investing in. And the way you do that, and the way you funnel, diba, or narrow down your selection is in this process below, like yung pyramid na nandito. That's why it's called the bottom up. So first, you start with the universe of issues that you might want to select. So you could define the initial parameter kung ano gusto mo. So like let's say for me, we're value investors. So part of our initial parameter would be, so ano ba dito yung mga stocks sa market na let's say for this year, down 20%, or the past 3 or 4 years, down 50%. At least you might have some semblance or idea now, these stocks should be cheap. Or you could also just make your life easy and say that your universe is the COL, lahat ng covered ng COL investment guide. I mean, that could also work. But after that, and the really crucial step here is the next portion where you conduct your fundamental and technical analysis. So the two squares that you see there on top, yung quantitative and qualitative factors, those are the factors that you consider to help select which stocks are really good. So quantitative, that refers to numbers, diba? What's factually there in terms of the balance sheet of the companies that you buy, there's earnings reports. And then qualitative, that's really more on the narrative side. I mean, how you perceive, how the market perceives management, diba? Are they good? Are they competent? So like I say, on the quantitative side, timeless to. You want to look for companies that have a strong balance sheet, meaning low gearing, wala masyadong utang. But you want to make sure that you're selecting stocks that when you project out their earnings over the next 3 to 5 years, it's going to continually grow. You want stocks to have good valuations, cheap, meaning low price to book, low price to earnings. Then you also need to identify like what are the drivers of the issues that you're buying that will make them move. So you might need to be a little bit more technical here. Like I say, for me, when I entered the market, the biggest stock in the market back then was PLDT, diba? And there was this term that you use in that space, ARPU, ARPU, average revenue per user. Diba? So pwede mo bantayan yung mga ganyang triggers to see, diba? If it's improving, then okay, sige. So maybe this stock is really beginning to do better. And then of course, on the qualitative side, you need to gauge management. You want to make sure that the company govern well, and then hopefully that it also has a good narrative. Right. So that's the bottom up. After you do fundamental analysis, you could also do company meetings and channel checks. So like I say, we're very fortunate. We are able to set meetings, like I say, with a lot of the companies that we follow. We get to talk to their CFOs, the presidents. They describe to us how the company is doing, what their prospects are. And actually, a lot of us here in this call, we're very lucky because this very segment, the COL Conversations, that's what the plan of the company was actually, is to be able to democratize the ability to meet with companies with the rest of the client base. But if you can't meet with the company directly, you could do child checks. If you ask your friend who works for Ayala Land, how are they doing? If you want to buy pure gold, you go to SNR, you go to their store, check, may mga tao ba? Bibili ba sila? So you do that, but just to help you gain conviction in terms of, like I say, the issue or the stock that you want to buy. And then you actually, so you've narrowed down your stock selection, then you execute. But what helps you execute is the next phase of the process, which is from bottom up. You need to regulate it also with top-down analysis. So top-down, this is what really helps us in terms of our risk management and timing. So you have a set of stocks that you determine that are good to buy on their own merit, but when to buy them, how much of them to buy, you also need to balance with what's going on in the overall environment. So for this, like let's say you start globally, what's going on? Is there risk on, diba? Is policy friendly? Are there global wars that are out there? And then after globally, you move to country-specific factors, diba? So demographics, what's the economy as a whole? What's the central bank doing? Are they cutting rates? So, and then what's the business cycle overall like? And then after the country, you move to sectors. So you compare, you do relative valuation, you compare the stock you have with others in the industry, you analyze growth trends. And then after that, like I say, when all of this checks out, where the stock where you want, it checks out on all of these factors, then you could also execute. So that's really the process. And if you would just really synthesize that, so what are the characteristics that you should look for in terms of the stocks? that you buy today, this is what you should look for. So you should look for issues with high dividend. Should look for companies that have low debt. Look for companies with stable earnings, pricing power, and definitely because interest rates are high, but the cost of money is high, the hurdle rate is high. You want to buy something cheap, something that has reasonable valuations. So this is the next one here is actually the universe of Philippine stocks that we would like to actually suggest to you for you to consider. Now, if you're doing it also on your own, this is something that you could take a look at and consider as well for your personal portfolios. So the way I did this is I tiered it. So first tier, long-term strategic positions. Next, our stocks within our preferred themes, the themes that we just discussed earlier. And then next is tactical big caps. So the way, at least just to view this and to look at this, when I say long-term strategic here, these are issues that you could already consider accumulating at today's levels. So as you can see there, the stocks that I identified here, the dividend yield of all of these guys are roughly around 5%. In terms of where they are trading, they're very depressed in terms of where they are in the chart. But like these companies, we've met with their respective managements and we like their management. We think that they are competently run companies. And for the long term, we think that all of these companies check out. So the next tier here, preferred themes. These are issues that we believe will benefit given the current environment. But yung difference na ito is you might need to be a bit more careful in terms of the timing. So it's possible, like I say, some of these issues are trading at overbought levels on the chart. You might want to time it better, or like I say, the sentiment towards them are a bit off at the moment. Like I say, you see the EMC and Semirara there. These are good companies. They pay extremely high dividends, but if you look at how coal prices are doing now, you can see it's a bit out of favor. So parang you need to wait for that dynamic to improve first before you go into them, but definitely you keep it in your short list. And then of course, the last tier here, tactical big caps. You always, I believe, like especially with a market like the Philippines, you always need to keep an eye out for the big caps because every time we're already a small market to begin with, pinakita ni Sir Marvin kanina, diba? 0.6 na lang yung allocation natin in the EM basket. The thing with big caps is that when sentiment comes back to the Philippines, when it becomes more positive, big caps are always the first to be bought because that's where the liquidity is. That's where the familiarity lies. So you could play it actually on a tactical basis. And my suggestion also, actually, if you do want to trade the market, if you're a bit more active, you could focus here because there's more liquidity here, diba? And if you're also the type na feeling mo, ikaw yung tipo na hindi mo kaya mag-cut, may binili ka, may chinate, hindi mo siya makat. At least if you buy this, you know these are good companies. These are going to be alive in the long term. But the strategy that you need to apply here when you trade it, when you buy it, it's a buy low, sell high approach. So at least in terms of priority, you do tier 1, tier 2, and then you do tier 3, the big caps on a tactical basis. And I guess just not to leave everyone hanging also, given that Sir Marvin there mentioned na if you look at the sequence, like right now, it makes sense to park in cash or very short-term interest yielding investments. Next is fixed income, and then next is equities, diba? So on the fixed income portion, this is, I think, the general strategy that you could adopt. I only outlined here Philippine government securities, and that's our preference as well because they are more liquid compared to, like, let's say, corporate debt. So the way this would play out in terms of what you would suggest, these are all tactical, by the way. You position first in treasury bills, shorter term instruments, given that there's still interest rate risk, volatile pa yung interest rates. So kapag sumiba bigla interest rates, longer term fixed income, longer term bonds, they're gonna take a hit on their capital. So tactically, if you're playing it tactically, dito ka muna siya short term, and then you can progress to the belly of the curve, 2 to 3 year notes, especially when you see rates are beginning to stabilize. And then later on, when there are more firmer signs that the economy is slow down, pwede ka na umusog dito sa treasury bonds or the longer dated type of securities because historically speaking, it's actually bonds that perform longer dated ones that perform well when there's a slowdown, when there's a recession. So you can also, like I say, in the short term, consider time deposits from banks as well. Mataas din yung binibigay na sila right now. But like overall, in terms of trading fixed income, I know it might not be also so easy. Like I say, I think most banks, they require you at least a minimum of 1 million to be able to trade and participate in the GS market. Yeah, but in general, this is actually the application, the specific application of what Sir Marvin mentioned there. That we could do.
Okay, thank you, Zerge. Thank you for sharing the game plan, and of course the rigorous investing process that the team goes through. We saw there, it involves a lot of timing. It also involves a lot of, not a lot, but it also involves different asset classes. No? So for our COL clients who are direct investors in the stock market, the question would be, how would they participate in the different asset classes like fixed income, or for our mutual fund investor clients who are a bit more passive, how will they participate in the correct timing? I guess this would be the perfect segue to bring in Marvin, where we could probably start talking about the COL Strategic Growth Fund.
Yeah. Thank you. Also, given what we said, the themes, as well as how the process is, some of our investors are not really able to get direct participation in, more particularly in fixed income, and some of the difficulties in the market. So that is the reason why we have recently launched this fund, call it a COL Strategic Growth Equity Fund. And we have designed it in a way that it can be all-weather, meaning it's an all-weather fund. I mean, especially now, for example, the fixed income market is doing very well, giving you good yields. That is where we concentrate. So let me talk about a little bit about the COL Strategic Growth Fund. But it is being managed by CMI, the COL Investment Management Inc., which is the investment company, the subsidiary of COL. So this marks COL's entry into the asset management business. We are now the one, you can give us now your funds that we can manage for you. So we're not just giving you access to the stock market through brokerage or mutual funds. You can actually invest in our funds, and we will manage it for you in the way that we believe is best for the customers in that fund. And right now, we have particularly two funds that are in our platform. We are licensed by the SEC, and the two funds we have is the COL Equity Index Fund and the COL Strategic Growth Fund. The COL Equity Index Fund we launched last year. This is really for those who want to just copy the index, and the CSG is the one more active. And the people behind here is really the investment committee. Now, you know these people. We meet weekly. This is chaired by our founder and chairman, Mr. Edward Lee, who has more than 40 years in experience in the stock market. Next, you have Mr. Dino Bate, the president of COL, has grown COL to over 500 customers, giving guidance to his customers on investing in the stock market. You have April Tan, who is our numbers person, the CFA, Chartered Financial Analyst, and Chief Equity Strategist. And then we have Juanis Barredo, the multi-awarded Chief Technical Analyst and the best technical analyst voted by the Fund Managers Association in the Philippines. And you have myself, more than 35 years managing funds, not just small but large institutional investors as well as in my previous life. So putting all together, our experience and expertise in that fund, in the funds that we are managing for you. And we actually have two funds. We have the passive funds, which is the COL Equity Index Fund, passively managed, tracks the index, measured by how accurately we replicate the index, and it's low cost. Now, CSG is now the one that we recently launched, is more active. And to give you more detail about the CSG, I think I'd like to invite Zerge to give you more color about the fund as the portfolio manager. Zerge?
All right. Yeah. Thank you. Thank you, Boss Marvin. So I will just summarize here, at least for the benefit of everyone, no, very quickly. You can read more about the fund actually in the COL Fund Source platform, but I'm already summarizing, at least here, the main and the most prominent features about the CSG. So first of all, the CSG fund that we're talking about, it's already COL Financial's flagship mutual fund offering. So kumbaga, if you look at other, like I say, fund houses in the market, they might offer a lot of different funds. So kami, we're just keeping it simple for you guys. We just have two types of fund that we offer. One is passively managed, one is actively managed. Both are equity funds. The actively managed fund is ito na yun. It's the CSG. So this is the fund where we will do our best so as to be able to actually return performance for you guys. So the CSG is an actively managed absolute return equity fund with the PSE index as its benchmark. So I just like to elaborate a little bit on these words very quickly. So when we say actively managed, ibig sabihin this is a type of fund wherein we do the heavy lifting already for you, the client. So we take into consideration the buying and the selling of stocks, the sizing, kailan ba natin gagawin yan, kailan ba tayo lilipat ng sector, yun na yun. That's the active management portion. We do the investing and the trading for you. When we say absolute return, what we mean by that is that this fund aims to achieve positive returns regardless of overall market conditions. Of course, there's no such thing as guarantees, but the way an absolute return fund is run, its goal is less in terms of trying to compare how it does versus a benchmark, but its goal, like I say, over the long run, is to be able provide positive returns. I think I'll be able to expound a little bit later why we think that would be appropriate, especially for a market such as the Philippines. But that's what absolute return means. It's to be able to achieve positive returns regardless of overall market conditions. But definitely, since it's an equity fund, the PSE index is what we will be using as benchmark for the long term. So the CSG is guided by COL's team of market experts. They need no introduction. Boss Marvin mentioned to you guys who they are. So if you're actually the type of investor, but like you watch April on TV, Juan is on TV, you attend all of our briefings and seminars, and you ever thought to yourself, paano kaya kapag sila yung nag-manage ng pera ko? That's kind of actually what the CSG is. It's guided by our team of market experts. And then lastly, a big advantage CSG has is that it's actually able to invest in various asset classes at flexible allocation levels. So what does that mean? CSG invests primarily in equities and its stocks, but it could actually also move into and invest in these other instruments: stocks, bonds, REITs, cash and deposit instruments, and even funds. Yeah.
So, Zerge, if I can just jump in.
Yeah.
So don't we also have like other actively managed equity funds that are available on the platform? How would this one be different from those?
Yeah, that's a good question, and this is how the CSG is different from other actively managed equity funds. So first, discussing like I say what we charge, the cost. I would think that this is actually a low cost actively managed fund. So we charge a management fee of 1.5% annually. If you look at the index in terms of in the market, what other actively managed funds will charge you, I think that's very competitive. And then we also don't have any minimum holding period, and we don't have any penalties for early redemption. Moreover, the initial investment that's required is just 500 pesos. And then if you want to top up or add, it's just 100. So actually, if you're the type of investor, diba, you're waffling, you're thinking to yourself, papasukan ko ba yan or hindi? I think it's worth a try. Diba? You go in, you notice its movement, it's not to your liking, you can pull out. There's no additional penalty for doing that. And the overall cost is 1.5% per annum. I think that's pretty competitive in terms of the industry. Again, it's managed by our people, the team that Sir Marvin mentioned earlier. And then the two real defining features in my mind are these two at the bottom. The fact that we have flexible asset allocation for this fund. and the fact that this fund can actually go 100% in cash. So I mean, actually, this fund has been around for almost about a month now. And I mean, I've been asked about, oh, Zerge, isn't that just a multi-asset fund? Isn't that just a balanced fund? And the answer to that is, I mean, you could think of it that way, yes. But the key difference is the fact that this fund could be focused, ultra and laser focused in the area that we think is best. So in that sense, parang yes, it can become unbalanced. Actually, that's what I'm trying to say, diba? So like, let's say normally balanced funds, 60-40 equities and then bonds. So like tayo dito, we can do 0% equity, we can go up to 100% cash. We can go up to 95% equity, 5% cash. Diba? We can do 85% fixed income, 15% stocks. So it really depends on the environment. Basically, the long and short of it is we will try to invest in the asset class that we think will perform best, for hopefully for the benefit of our clients. So that's why I actually have this graphic here and I wanted to show our audience. So we're trying to call the CSG actually an all-weather solution, because even though it's primarily equities based, the allocation between asset classes could shift dynamically over time. So this is a pie chart of where our assets are placed as of the end of October. And as you can see here, kargado tayo on the fixed income side. 85% of the portfolio is there as of the end of October. Equities is just an 8% portion. But now, like let's say, over the past few days, like let's say, for those of you guys that are a bit more in tune with markets, I mean, it had a very, very big move especially the US, the past few days because of a surprise positive inflation report. So like let's say for us, even our portfolio, I mean, the way we're trying to be dynamic, this equities portion here that you saw that was 8%, the end of last month, this one is around 30% already as we speak. So we try to move the fund basically in the asset class that we think is really going to be able to do best.
Yeah, I mean, 100% cash as an option, that's truly something different, no? It's even now they're showing us this 85% in fixed income, although as you mentioned, the last few days we've changed that a bit. I have a question. You mentioned that this fund has been running since last October 6th to be exact. Given that and given the allocation you put here, the 85% in fixed income, how is it faring so far? You know, like, has it panned out so far so good?
Yeah. Yeah. Actually, these are my last few slides though. And I will just jump to it at least in the interest of time also, so that we can accommodate a lot of the questions that our audience may have. So this is the performance of the CSG since its official launch last October 6th. So the dark blue line here is the CSG, the light blue line is the PSE. So as of the end of our first month of performance, which is at the end of October, the CSG was just down 0.4%, whereas the PSE index was down 4.6. So of course, I mean, our audience would know that the market in general fell during this time. And fortunately for us, we were able to outperform because of the way also that we were allocated less in equities. So of course, I could not always guarantee that this such outperformance like this will be able to hold. But like I say, in terms of us, the management, in terms of the way we are running the fund, we're also trying to protect your investment line, your capital. That's how absolute return funds try to work. You want to be able to return capital to investors over the long term, and you do that by protecting your capital. You don't want to see very large drawdowns in terms of the amount of investment that you have. So, kumbaga, I mean, if I could just give a very quick example here, like in terms of how this could work. But if you go to the fund management industry, for example, there's a particular year the index is down 25%. You have a fund that you're holding, it's just down 17%. Diba? So my question is, magaling ba yung performance nung negative 17% when the market was down negative 25? I think definitely, yes, magaling, diba? But at the end of the day, like I say, if you're the client, the asset that you're holding is still down 17% for that particular year. Malaki, definitely malaki yun. So like tayo, yung gusto natin gawin, you see the market down by a lot. Hopefully, hindi ganun kalaki yung tama. We want to be able to really build capital over the long term. So what I would actually just like to show here before we move to the Q&A, Chino, is that this type, I think, of fund, I believe, could work in the Philippine market setting just because of the very cyclical and boom-bust nature of the Philippines. So if you see the chart that I laid out here, diba? This is since 2013. So the PSE index tends to go up, then magsusole. Goes up, and then magsusole. Goes up, sole, up, sole. Soling malaki. Up, sole, up, sole, up, sole. Diba? So like that's why, like you see, we came up with a product like this, because what if in theory you see moves like this, diba, and you're able to reduce significantly your equity exposure? I mean, syempre, it's definitely hard to call the tops, right? But like, let's say as it's going up, you're seeing signs the economy is overheating or it's a bit expensive, diba? You take profits, ilipat mo muna sa fixed income or something. So that when the market reverses like this, hindi ka rin kasama sa correction and hindi ka magsusole nung kinita mo during these types of years. So our fund, I mean, given the very boom-bust cyclical nature of the Philippine market, that's what, I mean, of course, again, just to set the disclaimer, right? We're not saying we're always going to be able to do this perfectly, but this is what we're going to try to capitalize on and hopefully be able to shift in another asset class, like say cash, fixed income, when the markets are about to reverse. Yeah, that's so yeah, I think that's pretty much it. Chino.
Okay, yeah. Truly an all-weather solution. Galing. You know, it's I like that can adjust to any condition without the investor really having to do anything to it. Okay, thanks, Zerge.